Buyers take a step back at today's massive $42 billion 10-year Treasury bond auction. Some concerning signs showing weakening demand for longer dated U.S. bonds. So today, the U.S. Treasury Department sold $42 billion of 10-year Treasury bonds. Some pretty weak demand with this particular auction. Let's go through it. So high yield, 4.07%. This is what the auction cleared at. Remember, it's in the style of a Dutch auction. We can see, by the way, yields have ticked down by about 1 basis point since the auction cleared about an hour and a half ago. Now, tail, 0.6 basis point tail. This is the second consecutive tail in a row. Now, remember what this means. This is a sign of generally weaker demand. What this means is the Treasury Department had to offer a slight discount in terms of the bond's price in order to entice enough demand to come in and absorb the $42 billion of the total supply. Now, remember, because it's a bond, what that means, that lower bond price means a higher interest rate. So if you're a taxpayer in the U.S., you don't like to see a tail, because what that indicates is you, while the U.S. Treasury Department, therefore you as a taxpayer, are on the hook for a slightly higher interest rate than what the bond was trading at going into the auction. That is, again, that when issued, WI, sometimes abbreviated. Now, I wanted to show it side by side with the 3-year, which we just had 2 days ago. So you can see the differing demand profiles for different parts of the yield curve. Hopefully it's pretty obvious that, for example, back in 2022, look at all those very, very large tails on the 10-year Treasury bond auctions relative to the 3-year, which had one large tail of about 4 basis point. But taking that one very large tail out, it was nowhere near as weak as the 10-year. Again, something longer out in duration is much more sensitive to inflation, and therefore the demand will be disproportionately weaker for, say, a 10-year, 20-year, or 30-year bond if you are in a high inflation environment, or if the bond market is expecting that in the future. Now, what is the 2-year or the 3-year? What drives demand there? Well, it's Fed rate cuts. Now, arguably, the 2-year Treasury yield leads the Fed, and the Fed simply follows what the 2-year Treasury yield has done. We can see that actually going back decades. The 2-year Treasury yield makes the move months before the Fed, and the Fed just ends up kind of catching up to where the 2-year Treasury was trading at, or is trading at. As we can see with the 3-year, the past couple auctions have been quite strong. That is what you would expect to see if there was a lot of expectation for Federal Reserve interest rate cuts. Now, remember, the Fed only controls the overnight interest rate, that federal funds rate. And of course, the 2-year is much more sensitive to what the Fed is doing. The 10-year is much more sensitive to fiscal concerns. And this is the first auction, by the way, since President Trump announced the $2,000 tariff rebate check thing, which, by the way, betting markets have very, very low probability of that actually happening. And also remember that the U.S. is bringing in about $350 billion per year on an annualized basis in tariff revenue. Well, if you take $2,000 and multiply per the labor force of 170 million, you get about 350 billion. So mechanically or functionally speaking, if they were to do that, it would erase the tariff revenue for an entire year. And what that would mean is the U.S. Treasury Department would have $350 billion less than they do currently, meaning they would have to issue $350 billion more in bonds. Well, more bond supply, if demand is not changing, means the price must go down. Well, the price going down means a higher interest rate. So maybe this week auction today is the starting signs. Arguably, it started back in August. So if we look at the bid to cover, this is the total number of bids divided by the total amount of supply, 2.43. That is the second lowest going back the past 13 or 14 auctions all the way to August of 2024. So bid to cover is here in black. Again, total bids divided by the total supply. A higher number here is better. Lower is a sign of weaker demand. We can see that in black. The yellow line just shows you what yield the auction cleared out. We already went over that. And then the colored bars show show the composition of the buyers. So what this is showing is out of that 42 billion, what percentage were primary dealers or direct bidders or indirect? Now, primary dealers, those are buyer of last resort. They have a special arrangement with the Treasury to be the buyer of last resort. So you don't like to see a large primary dealer takedown. Now, in general, the long-term trend there with primary dealers is a declining share of these auctions, which is good. But if you look on a short-term basis over the past 3 or 4 auctions, we can see that primary dealer takedown, that share has risen. And direct bidders, those are firms bidding directly for their own book. That is in red. Then indirect is really important. That is that foreign demand. That is shown in green. That has been decreasing over the past 3 or 4 auctions. Now, the reason that matters is, of course, foreign demand, those current account surplus countries like, for example, Japan or China, those are strong hands that you want holding your debt. You don't want your creditors to be a bunch of 100-to-1 levered hedge funds in a tax haven. You want to see strong hands holding your debt because, again, if you are 100-to-1 levered hedge fund and your trade goes even ever so slightly against you, it could forcibly unwind your position. So again, a country like China or Japan that runs a very large current account surplus or trade surplus, that is who you want holding your debt. So generally, that indirect demand is very important. We can see the 6-month average, 70.2. We are down notably from that. So weak demand metrics for this auction. Tail, second consecutive tail in a row, highest going back to August. Low bid to cover. In fact, the second lowest bid to cover over the past 13 or 14 auctions. And of course, the composition of the buyers also weak. Primary dealers taking down the most share going back to August, the buyer of last resort, and indirects, that foreign demand notably below the 6 auction average. Andy Conson gave this auction a C- in terms of demand. Now, taking a look at the yield curve, here we're just looking at the 30-year, the 10-year, the 1-year, and the 2-year. And what I want to show is that how that short end of the yield curve leads the Federal Reserve. So we can see that the 1-year and the 2-year started to sell off in terms of yield, got bid in terms of bond price. The yield started to come down way before the Fed started to cut interest rates. So as we could see here, the 1-year and the 2-year were both indicating that the Fed needed to be cutting interest rates. Then, of course, we got that 50 basis point cut about a month or two later. So again, remember, the U.S. Treasury market is extremely large, tens of trillions of dollars large, and it can push around even the Fed. And the Fed arguably just follows the 2-year yield. You can see that. Anyone can pull up a chart and examine that. That is true, by the way, both in terms of cuts, but also in terms of hikes as well. Now here, for example, with the 30-year and the 10-year, we can see those yields are actually up recently. Since going back to when the Fed started to cut interest rates in September, we are clearly in a cutting cycle. And we can see the 30-year yield and the 10-year yield are both up. Now, remember, these are priced much more on fiscal concerns and nominal growth expectations over the future. So remember, nominal growth includes inflation and real growth. But then there's also going to be some amount of term premium baked into there, especially with something like the 30-year. And again, as the Fed has been cutting interest rates, what have we seen the 30-year and the 10-year yield do? They've gone up. Now, the 1-year and the 2-year have much different dynamics, but in general, what this has caused is a steepening of the yield curve. So here in pink, we are looking at the difference between the 30-year yield and the 2-year yield. Now, we were inverted back here, which is highly abnormal. And we uninverted a long time ago. We uninverted about a year ago, and yet we have not gotten that recession that, generally speaking, the bond market indicates with an inverted yield curve. And again, this is the first bond auction, longer duration bonds, since President Trump announced that $2,000 tariff rebate check. I also want to point out that Fed Bostic announced today that he is going to be retiring in February, meaning there's yet another another seat the President Trump has at his disposal on the Fed. And of course, Rick Reeder was out this morning talking about QE and the need to artificially suppress long-term rates. He was talking about the steepness of the yield curve. Again, the difference between what the long-term interest rate is relative to what short-term interest rates are. That is what the 30 minus the 2, the pink line, is showing. He was talking about QE to artificially boost the bond price of, say, the 10-year and the 30-year, which is, again, what matters much more for, say, credit card interest rates, mortgage rates, auto loan rates, personal loan rates, small business loans. Those are priced off the 10-year. And again, we had Rick Reeder out this morning talking about the need for further rate cuts by the Fed, but how that is a relatively limited tool. I mean, the Fed has cut significantly here. The federal funds was 5.3%. We are notably below that at 3.8. And yet, what has the 30-year yield done? It's gone up. The 10-year yield, it's gone up. So Rick Reeder, of course, pointing that out, basically, and saying that due to the activist Treasury issuance that started under the last administration, there is very small amount of supply being issued. Now, remember, if you're a pension fund, you have long-term liabilities. You have to match those long-term liabilities with a long-term asset like a 30-year bond. So there's always going to be some demand. And what Yellen started and Bessent continued is artificially reducing the supply at the long end to artificially boost the price and artificially suppress the yield. And what Rick Reeder, one of the top 5 contenders for next Fed chair, said, not only does the federal funds rate, the white line, not only does that need to continue to come down, but the Fed needs to basically artificially suppress the 10-year Treasury yield and the 30-year. And he said inflation at 3% isn't really a concern to him. He said only once it gets to 4 or 5%, which of course means the average American is paying in real actual inflation 6, 7, 8%, only then would he become worried. Well, you think the bond market is going to like that if you have a real GDP running at 4%, according to Atlanta Fed GDP now, and you have inflation at 3 or 4%, 10-year Treasury yield at 4.0 seems a bit mispriced. And of course, yields would probably trend higher, which again is the exact opposite of what we want. We want lower 10-year and 30-year rates because, again, that's where everything that actually matters is priced. It is priced off the long end of the yield curve. And I think evidence is showing them, slapping them in the face, that they do not have control over the long end of the yield curve. Now, should be pointed out, we are nowhere near as bad as a country like the UK or France or Japan. Our long end is much better behaved, but still, it is up significantly since the Fed cut from 5.3% down to just 3.8%. So, of course, Rick Reeder's comments, I went over that in the video I did this morning, so I would recommend you watch that if you haven't seen it already. He is one of the top 5 contenders for the next Fed chair, so arguably very important. And he's the chief investment officer at BlackRock. So, clearly someone worth listening to. So anyways, hopefully that was helpful, and I'll catch you in the next one.